take it away.
Sure. Okay. Hey, guys. So my name is Apaar. I'm a PhD student in the Department of Management Science and Engineering. And today I'll be talking about some work that I've been doing over the past year. It's basically on an application of deep learning for estimation of mortgage risk. Deep learning is a field I've been interested in for the past 2 years quite a bit. And this particular work, this is joint with Justin Siriano, who is now at UIUC, and Kai Giesecke, who's at Stanford. So feel free to stop me through the talk if you have any questions. Also, I have a lot of slides, and we probably have only 5 to 10 minutes. So this will mostly be like a preview of the work we've done. You can come to the poster afterwards. So essentially, in this project, what we've done is, at the heart of it, we have loans. And we have data about loans, and we are trying to predict how risky these loans are. And so I'll get into more details about the data, what the exact model is next. Our data is from CoreLogic. We have about 120 million loans, and essentially each loan can be in one of the 7 states. Current, delinquent. There are 3 states of delinquency: foreclosure, REO, and prepayments are paid off. And what we are trying to predict is, the problem we are trying to solve is, given all the information until the current time about this particular loan, what state, or what are the probabilities associated with this particular loan for these 7 states in the next time period? Okay, and then you can stitch together these forecasts to obtain essentially a multi-period forecast. So that's the gist of it. About the data, it's from CoreLogic. It's a huge data set. We have about 120 million mortgages sitting in there. And then we augment it further with different sources of data, mainly economic factors at county, regional, and local levels. And at the end, we end up having something like 3.5 billion samples, where each sample is a loan month pair. So each of these samples is about 300 features. So now, some of you might already be questioning, why do we need such a big sample? Like, 3.5 billion, that probably sounds ridiculous. And to some extent it is. We are using the data because we have it. But there are good reasons for why we need such an exhaustive data set. I mean, you want sufficient geographic coverage, and we have a few factors like county level statistics on unemployment, on house prices. So we do need that level of granularity. There are different types of products in the data set, and so what we are trying to do is use the same model for all the products. You could have one model per product, but this is the approach we've taken. And also, what we see in this data set is that there are several transitions. Like, if the loan has been performing well so far, then the chance that it goes delinquent or just goes straight to foreclosure, those probabilities are really low. So we need a large number of samples, which in turn means we need a lot of data. Also, our model has to be rich, and that's actually the entire motivation for using deep learning. We want it to be rich mainly because it should be able to learn all sorts of nonlinear mappings from the input to the output. For example, here we have prepayment rate as a function as it varies due to the time since origination. So due to all these things, we mainly need to have a rich model and a lot of data to train this model. Okay. So as I've already described, what we are trying to do is we are trying to estimate this probability. The probability that given all the information up till time t, the loan attains a certain state u at time t plus 1, right? And that we will do by estimating the parameters theta of some function h. And for this particular work, the function h is a neural network. So just to be more concrete, the input to the model will be data about this particular loan. So origination data, performance data, and then we also summarize all the entire performance data of this loan, as well as economic factors. And here we are in the month of May, and we are trying to make a forecast for the month of June. Okay, so we have 3.5 billion such samples, and we feed them into a neural network. Now, some of you may not know what a neural network is, so I'll just spend like a minute on that. Essentially, these are the inputs the things in red, the cells in red represent the inputs, and you're taking a linear combination of them, and then applying a nonlinearity, a very simple nonlinearity, something like maxing with 0, a really simple function. And so this layer here, which applies just an affine transformation and then a nonlinearity, is called a hidden layer. And so if there was just one hidden layer, this would be what is called a shallow neural network. In the output, it would predict the probabilities corresponding to the 7 clauses. But what we are interested in is if we stack up many of these layers, can we improve the performance? And that's really the thesis of deep learning. And what they found in several different applications, like computer vision, speech, is that our predictive power of the model goes up, obviously at the cost of requiring more data and more parameters. So we repeat several such hidden layers and obtain what is called a deep neural network. Right, so such networks, they have a lot of parameters, like we have our 100K parameters, and we go through what is called hyperparameter optimization in order to figure out what the optimal configuration of the network is. Also, we train this network, that is, we learn all these affine transformations inside the network, and we do this by a process called backpropagation, which is essentially gradient descent. The challenging part is that the scale of doing this requires that we have a good computational setup, and so that means using GPUs on AWS, setting up a cluster environment, because our data needs to be shared between several models which are training on the same data set. We don't want to replicate a 1 terabyte model like 10 times. So it requires a lot of deep learning technology, essentially. And so here are the results. Like, essentially, you're spending sort of like 80% of the time on just the setup and the data, and then finally you end up getting these results. So what these results tell us is that we've experimented with several models here. This is logit, or logistic regression, or essentially a neural network but with 0 hidden layers. And then we successively keep increasing the depth of these networks, and we observe an improvement in the error rate until about 5 layers here. Also, I've mentioned dropout and no dropout here. Don't worry too much about that. Dropout is a regularization technique, which is often used for neural networks. And so this tells us that 5-layer neural networks, or at least for this particular application in finance, it seems like 5 layers is probably a good depth. That's some information, because then you can compare it with the depths of neural networks that people use in other fields, like computer vision and so on, where you require networks which are much deeper. So it seems like the accuracy is sort of saturated around between 3 and 5. Now, what you can do is this loss is not really interpretable. Like, you cannot really tell how good this network is. So now, the next few steps what I'll do is I'll go through a bunch of standard ways to sort of understand how good the network is, and then I probably won't have time, but there'll be ways of sort of understanding which variables are the most important. Neural networks are largely still a black box, so unfortunately, you cannot really use them much for interpretation. But we try to do as much as possible, and you can come to the poster after this for more details. So we do the standard AUCs and ROC curves, and one important takeaway from this slide is that it seems like logistic regression and shallow neural networks are all as good as the deep neural networks for predicting every state except prepayments. So specifically for prepayments, we see that logistic regression has an AUC of 0.64, whereas neural networks and their ensemble have AUCs of around 0.75. So it seems like it learns prepayments paid off state pretty well. So we also have some other metrics, like here the AUCs were sort of like for every final state, and now we also have AUC matrices. These are just more in-depth metrics, performance metrics for the model. The main takeaway is that this is the AUC matrix for 5-layer neural network. This is for 0-layer, And we see the former is like, overall, it's much darker, and darker is better in this context. It means higher AUC. So that's just like one way of. So I guess this is probably the first and the only metric that I'll talk about here. What we do is, so the question is, how do we sort of use this model outside in the finance world? One experiment you might want to consider is where, let's say you have a loan of you have a pool of 100,000 loans, and let's say you're asked to select some 20% of them and told select the best portfolio so that, let's say these loans do not remain, most loans remain current after 12 months, okay? So now you can rank these loans based on the probabilities that they will remain current after 12 months using a neural network model or using a logic model. And so at 20%, what we can see is that after 1 year, once we wait for these loans to default, go delinquent, foreclose, and so on, that around 20%, the numbers from the neural network are much better. There are much fewer loans here that have gone delinquent or have defaulted, and these are the precise numbers. We see that after 12 months, 93% of the loans still remain current, whereas it's 89% if your portfolio were to be chosen using a logistic regression model. And the main difference, the main 4% here is shifted to prepayments. We see a lot less prepayments for the neural network portfolio, 4% less, which again, tells us that it's a good metric. It's a good model for prepayment prediction. So we have I have several more slides about how you can interpret the network, how you can rank the importance of various inputs to the network, which I won't cover here. But yeah, that's basically a gist of my research work. Let me know if you have more questions. Yeah.
Thank you very much, Apaar. Much appreciated. Okay, we're going to have our next speaker, who is also from Stanford, starting in about 3 minutes. So fill your plates, fill your cups, and we'll hear from Michael Ohlrogge in just about 3 minutes. Meet us back here.
Okay, thanks. Can I get your slides? Of course, yeah. That's why I put all the information in them, of course.
Is it light green?
It is. Also, I noticed when Apaar was speaking, it was hard to hear him in the back, so you might want to just remind other speakers to.
All right, everyone, let's go ahead and bring it back in. Michael's going to give us a rundown of his recent work, and let's give him our undivided attention. Thank you, Michael. Take it away.
Great. Well, it's a pleasure to be here with all of you, and I'm actually delighted to be following up on my colleague Apaar's presentation because this very much ties in with his. And so this is work on loan-level capital modeling for the government-sponsored enterprises, and it's joint with my colleagues in the Management Science and Engineering Department at Stanford, where I'm a student, and with my colleagues Kai Giesecke, who's the supervising professor, and Robert Stacy. So what we are trying to do here in this research, as you folks know, during the financial crisis, we had these government-sponsored enterprises, Fannie Mae, Freddie Mac, collapsed terribly. They had been guaranteeing tens of billions of dollars worth of mortgages and mortgage bonds that they had insured. That did not work so well. And so what we're trying to do here is develop enhanced risk model loans for these entities for two reasons. One of them is to hopefully be able to identify ways that they can enhance the safety of their business going forward, and in particular be able to identify risks earlier than would have been possible otherwise. And then another is that there's been a lot of interest in reprivatizing these institutions because they're still in a government conservatorship. And so there have been politicians, there have been nonprofits, there have been market participants who have been saying it's a little bit odd that the government's running sort of this, big housing insurance agency. Maybe it makes sense for them to be privatized, but if that is the case, how much capital are you going to need in order to establish viable entities? And right now, there's not been a whole lot of particularly sophisticated analyses of that. There have been some very, very back-of-the-envelope sorts of work done, and so we're trying to also get something that can inform policymakers who are looking at a question like that. So basically, this project has a number of portions. We first look at developing a loan state transition model, which Apaar has spoken of in depth, and so it's much the same sort of thing that he was presenting on. From there, we look at a loan loss given loan status model, and so that could be whether the loan is in default and what kind of losses are experienced in that case, but also if it's delinquent and payments are being missed, or if the loan is modified with, for instance, a principal reduction or an interest rate reduction, then what sorts of losses are going to accrue in that sense. And then eventually we translate those into a portfolio simulation to try to understand what are the possible impacts portfolio-wide based on all of these loans. So we're working with about 23 million loans from Fannie Mae, about 1 billion loan month observations. We also do similar work with Freddie Mac data, and it's a similar situation, but this presentation here is just on the Fannie data. And we enhance that then with a lot of economic predictor information. And so the first part of the work is a loan stage transition model. One of the challenges here is that you tend to find highly nonlinear relationships between various risk factors such as loan to value ratio and interest rate and the risk of the loans. And so that creates somewhat of a challenge when you're talking about modeling. A more traditional approach might be to take a logistic regression, maybe try to come up with polynomial fits of the predictors in that, maybe try to sort of do a little bit of guess and check work or some reasoning about what kind of interactions do you want between them. But it's pretty difficult to get it as precise as you might want it. So another option then that we pursue in this paper in parallel to that is a neural network machine learning technique, which is able to capture both the nonlinearities within a given variable's relationship to the risk outcomes of interest as well as the interactions between the variables. Now, obviously, there's downsides to that. It's a black box, so you're not as certain about what kind of a relationship is actually modeling. You have a less of an ability to look at it and say, does this seem reasonable? There's also concerns with overfitting, which is a particular concern if you're talking about capital modeling. And so you might get a beautiful, beautiful fit to today's data and the past year's data, but if it's not going to continue on to be very valid in the future, then that can be a big issue. And so that is also at a lot of the heart of what we're working on in this project, is working on ways of developing sort of robustness analyses. If we're going to be applying a machine learning technique, how can we do it in a way that we have some confidence that we're actually getting something that can be useful into the future? So this particular project is relatively early stage, but what we're seeing is pretty typical of a neural network. We're getting an enhanced ability to predict loan outcomes. So here, for instance, this is looking at trying to predict within a year forecast which loans are going to be prepaid. And the red dots here represent the results from the neural network, the blue dots from a more traditional logit, and the diagonal line would represent a perfect prediction in terms of matching the number of observed prepayments to the number of predicted prepayments. So it is an enhanced accuracy to that. Moving on, though, just given the limitations of time, we've got then, so after we talking about this loan transition model, transitioning between current to prepaid or current to delinquent, then we think about, okay, so given that a loan is transitioned to a given state, what kind of a loss is going to accrue? So right now what we're looking at is an inflated beta distribution. And so if we think about, for instance, on the event of a loan defaulting and going into foreclosure, you can range anywhere from 0 loss, in which case perhaps the property is foreclosed upon, but the lender is then able to sell the property. It covers the outstanding balance of the loan, which would be a 0 loss, or it could be a 100% loss, in which case, basically you're able to get no recovery from the property, or maybe you're able to get a small recovery from the property, but the fees of handling the sales and maintaining the property in the interim completely swamp that. And one of the really neat things about this data that we have, the loan level data from the government-sponsored enterprises, is it has the detailed information about precisely what were the losses and what were the sources of the losses on the loans in the portfolio. And so because of sort of this situation where we're looking at losses on the unit interval, but at the same time you can actually have 0 losses or 100% losses with non-negligible frequency, we didn't want to use just a standard beta variable because that would not give us the clustering at the end. And so we do an inflated mixture model that's able to represent basically a combination of the binomial outcomes and the end points and then the continuous outcomes in between. And what we see here is it does seem to fit the data pretty well. So on the right here we have the empirical distribution of losses given default, and then on the left we have the predicted distribution, and it fits quite closely. I mean, obviously this is a single plot, but it is something that we're using. And so once we have that, then the last stage is to put this together into a portfolio level analysis. And basically what we do here is we take a number of we basically take a stress testing approach. So we take half a dozen or so key economic predictors in the model, things like interest rates, for housing prices, and unemployment, and so forth, and run them through a number of stress scenarios, and then see, okay, so what kind of predicted transition probabilities does this give for each of the loans in our sample for each of the months? Then we randomly sample weighting by those probabilities to simulate those transitions. We do that about 1,000 times for 1,000 different time periods, and then look at the losses that are accruing either from the missed payments or the foreclosures. And then we look at the distribution of those. Ultimately, what we hope to do is to be doing some back testing, and so to be analyzing the robustness of stress tests like these. So for instance, what would happen if we ran a stress test in 2004? How predictive would it be in actually identifying risks? So that's a further part of the project to come. But what we see here is we're able to, through those simulations, generate distributions of the different types of losses. So we have losses from the defaults and the foreclosures, losses from the delinquencies and the missed payments, losses from the write-downs of the interest, and then a total loss distribution. And so right now, at this point, we're analyzing just the 30-year fixed-rate mortgage portfolio of the Fannie Mae. And what we see is, generally, depending on the specifics of the stress scenario, we're looking at somewhere around $8 to $10 billion of potential losses on that. Now, it doesn't account for things like hedging transactions. It doesn't try to ask some of the difficult questions about, okay, well, now you've suffered a $10 billion loss. You've got, $50 million left in capital. Probably you're not going to be a viable entity at this point. At what level of capital adequacy are you going to still be viable after suffering a loss of this sort? So it's an initial foray into these things that's continuing research. But really what we're trying to do, like I said, is these two things: both develop better, more accurate capital models to enhance sound business practices, but also to try to give a better sense to policymakers of how much money would these entities need to raise if they're going to be viable going forward. That's it.
Outstanding. Thank you very much, Michael. Okay, we're going to have our third presenter up in about, again, 3 minutes. So fill your cups, grab a bottle of water, load food onto your plates, and we'll see you back in 2 to 3 minutes. Thank you.
I think I'm on. Am I on? I'm on.
Thank you again, everyone. Let's turn our attention to Nick Gunther. Besides having a great first name, he is an excellent researcher. Nick, take us away, sir.
Good evening. Thank you for coming. So we learn as an elementary matter that not only should there be no arbitrage in most of the markets that we want to model, but we get accustomed to assuming there is no arbitrage because we get such nice, clean results. There are powerful arguments to think that a static arbitrage, such as, for example, a forward contract on gold or foreign exchange, is impossible. But dynamic arbitrages require a lot of attention, and sometimes they go very wrong. And not just because the trader stayed out late and didn't get in until after the open. What is the consequence of the existence of dynamic arbitrages? We tackled this problem, and this is joint work between Bob Anderson, Lisa Goldberg, and me, by looking at one of the simplest and most common derivative contracts, which is the S&P 500 futures contract. Because it has, as we'll see in a little bit, daily cash flows as a result of the daily variational margin postings, which is substantially equivalent to daily mark-to-markets. It cannot be statically hedged into a conventional financing. Thinking cynically, perhaps because of that feature, some somewhat extravagant claims have been made in the financial press about just how low a financing rate is achievable, of course only to hedge funds, not to individual investors, by investing in equities through futures. All of this led us to the question of what is the true financing cost of a levered equity investment strategy, specifically the implicit financing cost of investing through a futures contract. There are two pieces to this investigation. One is a finance theory piece. The other is a data piece. Together, this research showed that the implicit financing rate available by a indirect derivatives equity investment through a futures contract, has often offered a financing rate that has been attractive relative to market rates on an explicit financing, which is the most natural alternative. However, this relationship has been volatile and varied based on both legal and economic regimes. At any given time, there is an implied borrowing rate associated with a liquid futures contract. The spreads between this implied rate and a standard market rate on an explicit financing, such as a treasury rate or a Eurodollar forward rate, has varied. And over the period at which we looked, from 1996 through 2013, has shifted based on 4 separate regimes, which are shown in the heavy lines on this chart. Now, this is a very colorful chart, and colors are, of course, eye-catching, but can be a little confusing. The blue line, let's see, is this estimated FIR, this implicit, unobservable rate offered implicitly by an investment in the derivative S&P 500 futures contract. The red line is a Eurodollar rate, and the green line is a treasury rate. Claims by hedge fund managers have included the statement that the implicit financing rate available to the knowledgeable adepts through futures investments are close to zero, considerably lower than the rate on US Treasuries. This does not appear to be true. Now, prior to 2001, the FIR estimate from our research was regularly above even the Eurodollar rate, which is a rate that, like LIBOR, can be viewed as a proxy for a standard corporate borrowing rate. And a fortiori was markedly higher than the US Treasury rate. Now, at the end of 2000, Congress passed a new law intended to simplify and streamline and regulate more effectively the derivatives markets, including futures. And it seems to have worked, because starting in 2001, we see that the implicit futures implied rate dips consistently below the Eurodollar rate and even occasionally below the Treasury rate, but it really never gets consistently near zero. Whoops, sorry. Then in the financial crisis, we see that the futures becomes the implied financing rate implicitly available through futures significantly exceeds the Treasury rate and is generally comparable with the Eurodollar rate. And then as the financial crisis of 2008 recedes, it reverts to the pattern after the passage of the Futures Modernization Act in 2001, where it's generally somewhere in between the two market rates. One of the first challenges that we confronted was a data challenge. The natural comparison based on which to estimate an implied financing rate from a futures is the futures price and the spot price. But unfortunately, the two markets close half an hour apart. And half an hour is an eternity in a world with equity volatility. So instead, we estimated the FIR entirely by reference to futures prices. Specifically, we took the consecutive pairs of the earliest maturity contract, referred to as the near, and the next earliest, referred to as the next. Logical people, these futures traders, and formed pairs, I think about 26 pairs from 1996 to 2013, looking only at days in which there was significant volume in both contracts. Finance theory then gave us a means to determine the financing rate existing entirely within these contracts from the observed futures prices. And these equations, of which the last one formed the basis for our estimate, come from two standard results. The first is the standard no arbitrage arguments that give rise to the martingale pricing formula applied to the S&P 500. And the second is a very nice result specifically applicable to futures, which is that the futures price is equal to the expectation of the future stock price under the risk-neutral measure. Now, in martingale pricing, you derive a formula for the current price of an asset as the expectation of its deflated future value. But this result provides a formula in terms of an undeflated expectation of the future stock price. And that's the difference between the futures price and the spot price, the lack of a deflator. So in this formula, T sub 1 is the maturity of the near, and T sub 2 is the formula of the next. S is the S&P 500 index. And this formula would provide a complete basis for estimating the FIR, the implied financing rate, except for the covariance term. So we had to spend considerable effort bounding that covariance term, which we treated as noise in our estimate. And when we finished, we had another colorful chart of spreads between this implied financing rate implicit in the purchase of a futures contract, spreads to the two market rates I referred to before. On the left, we have spreads to the euro-dollar rate. On the right, spreads to the treasury rate. And we've treated each regime separately. Of course, these spreads are mean reverting. A simple inspection of a graph reveals that. And we found that they were reasonably well modeled by Ornstein, Uhlenbeck, or on discrete terms, AR1s. So the box plots show in each regime for each spread comparison, euro-dollar against euro-dollars or against treasuries, the dispersion of the spreads in that regime relative to their long-term reversion mean, which is given by the large black line in the middle of the box plots. And then the dotted lines are the 95% confidence intervals based on a block bootstrap. These box plots show the same conclusions that I already referenced, but in somewhat more detail. Relative to treasuries, we see that the implied financing rate usually has a positive spread. It started out considerably positive, over half a point, and then after the passage of the conforming and streamlining regulation, the Commodities Futures Modernization Act of 2000, the spread compressed considerably. But the financial crisis of 2008 widened it right up again, although not as wide as before. And as the markets recovered, the spread contracted, but not to the level immediately after the passage of the CFMA. The progress with respect to the euro spread is in some ways a mirror image. Before the CFMA, the spread was generally positive. Afterwards, it was generally negative, but during the crisis, it was dramatically negative. And to understand that, one remembers that these contracts are marked to market daily, and so the credit risk associated with the futures is very, very low, which was very attractive relative to a corporate loan in 2008 and 2009. But as the crisis ebbed, we see that the spreads came in again. Although once again, they didn't widen out to the spread immediately after the passage of the CFMA. And that brings us to the end of this quick view on our conclusions. Thank you very much.
Thank you very much, Nick. We're going to take another 3-minute break for water, wine, food, and then we will come back for our final presentation. We will see you in 3 minutes. Also, if you want to talk to the presenters today about their work, about what they found, about what they still want to find, after our final presentation, we have some time to hang out and dig into some of those questions that I imagine many of you have. So, 3 minutes. We'll see you back here. Thank you. All right, everyone, let's pull it back in for our final talk of the evening. If you are gathering, hunting and gathering food and wine and beer and water, we welcome you back. So, our final talk is going to be presented by Farzad Pourbabaee. Is that? I really wanted to get that right. Farzad, take it away, sir.
2 days, tonight's seminar. It's really be a great pleasure for me to give a talk in such a beautiful room. Well, I'm going to be speaking about the large deviations of the regularly varying multi-factor models, which is partly, I mean, I mainly did this work in the summer, and actually I'm a second-year PhD student in the econ department at UC Berkeley. Yes. I think you all are familiar with this asset return multi-factor models, which basically we assume that the return to the security is the linear combinations of some factors. Here we have the phi 1s to phi k's as the factors, as the underlying factors, which usually can be extracted out with some PCA methods together with some sparsity constraint over some factors relative to the others. And then on the top of these factors, we might have some idiosyncratic noises, which is captured by epsilon here, which is usually assumed to be uncorrelated with the other factors. The additional constraint or the assumptions that they made is that the factors not only are uncorrelated with each other, but assume that they are also independent with themselves. So the questions that I'm going to raise and then answer in this talk is that what are the asymptotics of your security, of your asset returns, which is denoted by psi here, being extremely large. So I'm interested in finding the probability of psi being larger than x, where x is also a great number. So we know that there are some good bounds if the phi 1s, I mean, if the factors are sub-Gaussians or sub-exponentials, we can just use all of those large deviations bound. But in the real world, we do not, know enough information about the distributions of factors. The best thing that we can say is about some rough estimates about their tail or the decay rate of their tail distribution. So we have some partial information about the distributions of the factors. They're not fully categorized. I mean, they're not fully known to the person who was doing this risk management. So this is the assumption that people usually make, and they kind of supported these assumptions by the observations that they saw in the market. I mean, here you could see the the empirical return to the S&P 500 from the 1993 to 2016. These are the blue lines, and then I overlaid it with a Gaussian distribution. As you could see in the center of the distribution, the Gaussian distribution over-approximate the mass. So it means that at the right end, as I get further off the origin, there would be more mass by the empirical data, which is an indicator of having fat tails, of having great masses at the two sides of this spectrum. And I calculated the kurtosis. It's way larger than the kurtosis of a normal distribution, which also is another indicator of having fat tail. So these sort of problems of having heavy tail data is well addressed in the Gabo paper in 2008, and it's a really great paper. And they actually, he actually provides some reasons that why we have these power law distributions in the market and why they really emerge. Okay, so the type of the distribution that I mainly focus in this research is the slowly varying distributions. They have a particular definitions, and the definition is that the tail of your distribution is behaving as a multiplication of a slowly varying function, which is captured by Lx and satisfies equation 3. And then there is this polynomial decay, which is pinned down by x to the alpha, and the alpha denotes how fast this polynomial goes to 0 as x goes to infinity. There are some important subclasses of distributions that are categorized as elements of this regularly varying distributions, like Pareto distribution, like log normal, and Weibull distribution. So what is really important for us is to have an estimate over the alpha, or the decay rate of the polynomial in the denominator. There is this known nice approximate estimator, which is called the Hills estimator in the jargon, which basically picks the k largest elements of your data set and apply this formula number 4, and you get an estimate of the right alpha. So basically, it only works on the k largest order statistics of your data. And if you look at this formula, and again, over the S&P returns from 93 to 2016, this is what you get if you plot the estimates of alpha hat, based on k. And k over n is this ratio. K is, again, I'm going to repeat it. It's the number of the highest order statistics. So you could see that the alpha actually stabilizes somewhere between 2 and 3, and this is an indication that the power law tail, the power law decay, has an exponent of somewhere between 2 and 3. So it kind of validates the assumption of having power law distributions for the returns of the assets in the market. So this is it. So the theorem that I proved is that what happens, again, I assume that the factors are independent, not just uncorrelated. So what happens if we add these factors, x1 to xn together, they are independent of each other, they are R-valued, not necessarily positive or negative, and they also not have identical distributions. Under some regularity conditions, such as 1 and 2, which I'm not going to go through that, you can prove the equation 6, which says that the deviation probability of sum is actually the sum of the individual deviations. This is not always true in statistics. This is definitely wrong. But for the case of a slowly varying distribution, when x goes to infinity, these two sides are asymptotically equivalent. Actually, if you get the ratio tends to be converts to 1 as x gets larger and larger. So I think this is a nice result. At least it gives you an idea to how to calculate the deviation probability of sums. And not only we have this result, we have this catastrophe principle result, which gives the same bounds on the maximal factor, okay? So the probability that the maximal factor passes a certain level is again the sum of the deviation probabilities, and this is only true for the case of slowly varying distributions. And the observation that one can make is that in the market for the asset returns, you cannot have extremely large deviations unless at least there is one factor among the constructing factors that can support such a large deviation. You can never aggregate the small fluctuations and get a very large event. Okay, so there has to be at least one factor which has such an extreme deviation. So this is I think this is a whopping result, not like that. And then, I mean, at the end of the talk, I would like to introduce some methods to estimate the probability of deviation. These are just some theoretical results, so we would like to have a hand on how to calculate that large deviation probability. One can naively just use this theorem. If you look at theorem 6, the very right-hand side, you could see some approximator of the sum of the deviation probability of the sum. One can take that and use it as an approximator of the deviation, and it turns out to be a really inaccurate approximation. The condition, but there is an alternative way, which is first introduced by Asmussen in 2006. He finds this large deviation probability for IID factors, for IID random variables, which are positive. Actually, I generalized their methods to the independent factors, but not identical, and are valued. So I take his methods, and this is the conditional Monte Carlo steps that you can just follow and get an estimator for this large deviation sum, for the large deviation sum. Yeah, you're basically going to draw random each xi from the distribution fi. So fi's are different from each other from each distribution. You're going to draw a random variable. You're going to take the maximum of those random variables, call it mn, and then you're going to take them. You're just going to follow the sum. That summation that you could see here in step 3 is a conditional probabilities, and the fact that we have this conditioning actually greatly reduced the variance. So this variance reduction is high to some extent that we get a very efficient estimator. And we get in the last theorem, you could see that this variance reduction is high enough that we get a bounded relative error, which says basically it tells that the variance of your estimator divided by the second moment of estimator gets, it's finite no matter how large x is. So as you tend x to infinity, this ratio remains finite. And I think this is an important result which tells about how precise your estimator is. Yep, and lastly, this is an application. I first got to know that when I read this Bouchard and Pottersburg on financial market, which I really suggest everyone who is interested in this field to read this book. They just raised this interesting case that when the asset returns are linear combinations of some factors, and those factors are themselves having power law distributions. So each of phi 1s to phi k's have heavy tails. So because of those theorems, you can just prove that the probability that psi as the return being greater than x is basically governed by the heaviest tail. The only factor that really contributes to this probability is the one which has the smallest alpha or the fattest tail. And you can just see that, and with it some normalization constant, which are the sum of the CIs. Yes, and I think that's it. I would like to finish on time, as Nick told me. Yes, and these are the set of references. Again, I would really like to emphasize on the Bouchard books. It's a really great and awesome book. Yeah, and thank you all.
Thank you very much, Farzad. Alrighty, that is the end of our presentations for the evening, but please feel free to hang out, help yourself to some food, help yourself to more fluids, and talk with our researchers who are still able to stick with us. And I look forward to meeting those I haven't met yet. Thank you for coming. We appreciate it. And cheers. Have a good evening.